Hi, and welcome to the ECIO market commentary for the month of May. May was another good month for investors as US stocks were up 1 to 5%, overseas stocks up 3 to nearly 10%, and fixed income results up a modest zero point 0.1 to 0.3%. That takes year-to-date results for the 5-month period for US stocks up 9 to 18%, overseas stocks up 9 to over 25%, and fixed income results up a modest 0.3 to 0.4%. Over the past year, it has been a great period for the S&P 500 with the index up nearly 30%. It has been volatile, particularly in the first part of this year. Starting in at the end of February, when the Iran war began, we saw a downdraft of nearly 10%, followed by this latest rebound, which has been driven by optimism over AI, as well as strong corporate earnings. From a sector perspective, in May, the market was narrow, driven primarily by the technology sector, as you can see, up 16%. It was the only sector that outperformed the overall index, and a number of sectors were actually in negative territory. So all in all, again, the S&P up over 5%. Market shrugged off a lot of the geopolitical volatility thanks to optimism over AI, as well as very strong corporate earnings. Overseas, we saw emerging markets extend their leadership up over 25% now. A lot of that was driven due to the fact that South Korea and Taiwan have very heavy technology exposure in that index. Meanwhile, bonds were generally positive in May, but have been challenged on a year-to-date basis. The 10-year Treasury yield actually reached 4.45% at the end of May. That is up from under 4% before the war began. So pretty significant shift up in longer dated interest rates. Looking at economic and policy data, the Fed did welcome a new chairman in on May 22nd. The outgoing chair, Jerome Powell, is going to remain on the board, which is a little bit unusual, to help protect the central bank's independence. On the global front, we saw global economic growth soften, highlighting the emerging stagflation risks. Stagflation, of course, is low growth or no growth with elevated inflation rates. Simultaneously, we've seen an unprecedented energy crisis as total global oil supply has plunged nearly 13 million barrels per day since the war began. So that has, of course, put pressure on inflation. And in fact, the consumer price index was reported hotter than expected at 3.8%. That's fueled by broadening pass-through of energy costs into core goods, grocery staples, and services. In turn, U.S. consumer confidence has remained low. We're actually looking at a scenario of a K-shaped economic outlook, where on one hand, the affluent consumers are doing well and feeling okay, but the low-income consumers are under a lot of pressure due to rising costs in energy, food, and housing. On the geopolitical front, despite a brief spike in oil prices during May, we did see energy, the price of Brent, drop about 17% towards the end of May at $92 on optimism that there may be a breakthrough for peace. So as we look forward into next month, we think investors are going to continue to be focused on the Fed and what the Fed action may be. They're boxed in a bit with a high level of inflation. Also, a lot of focus on the continuing rollout of AI, the impact that that might have for continued capital spending, as well as productivity enhancements, and of course, the economic fallout from the closure of the Strait of Hormuz. So that's a quick update for the month of May. If your investment committee has any questions or would like to meet with us, please reach out. We'd be happy to do that. Thanks for your time and interest, and have a great day.